Last week, the stock market hit new highs, so what can we expect with this hot stock market? That's what financial expert Barry Watts is here to talk about on this week's edition of Money Matters. Welcome back, Barry. Good to see you again.
Thank you. Always delighted to be here.
I mean, I know we can't etch it in stone, but in your opinion, what's next?
Well, we hit new highs. The Dow at an all-time high of 17,000. And I think the next thing that's going to happen depends on who you ask. I personally believe we're poised for a significant correction. That doesn't mean that it starts tomorrow, but in the nearer term, it's sooner instead of later.
So how do you, what are the indicators here? There are indicators that people look at and sort of get a feeling for all of this. What are those?
Well, there are a lot of tea leaves you can read, and they will all tell you different things, and it depends on who's interpreting them. There are three that are significant to me that I want to talk to you about today. The first one is actually on the graphic that you see on your screen. You'll notice on the far left side, you see an arrow indicating a market top. And that was in 2000. This graphic actually covers from 2000 up to today. And you'll notice in 2000 where the market was, and you'll notice that it took a major tumble in 2000. Then it finally recovered, and you'll notice that that recovery hits over in the middle of the screen in the second arrow about 2007 or 8. And then you'll notice it tumbled again. So every time there is a top, we see a tumble. Now I want you to notice the red line all the way across the top of the graphic. What that indicates to us is that money hasn't been made in the stock market since the year 2000, except for the circle in red. The last 12 months or so, we've made money. So everything that you've made in the market in the past 14 years has been made in the last 12 months. And if you notice, after every top, there's a fall, and it looks to me like we're positioned to be ready for the next one. So that's the first indicator.
I notice also that fall seems pretty abrupt versus that slow climb back up to that red line.
Well, doesn't it?
It is abrupt and it's painful. The fall generally will be of about 38%. When a market does go into a bear decline, it's 38%. And from the beginning of a bear market to climb back out on the other side and get back to where you were takes about 77 months on average.
Oh, and that's tough when you think about it. But then you start getting into, you know, time is on your side.
Well, is it?
Isn't it?
Depends on how old you are.
Depends on how old you are.
If you think about 77 months and how many years of your life that covers, some of us are getting long enough in the tooth that we don't have a lot of 77 months left.
Exactly.
That's true.
Depends on when you start,
That's
though, when
correct.
you say, yeah.
So how do you head? You know this is coming, but, you know, there's obviously no one has a crystal ball to say exactly when. How do you hedge for something like this?
Well, there's some things that you can do, but first you have to realize that maybe we do have some things that give us an indication about when. For example, there are bear markets approximately every 4.8 years. There have been 16 of them since the Great Depression. We right now are 5.3 years, actually 5.4 years into the current bull market. So we are overdue for a correction in the markets right now on that basis alone.
Will that make it a harder fall if we're well overdue?
Well, if you subscribe to the coiled spring theory, yes, you would say that the market is continuing to coil like a spring, and when it goes against you, it'll go against you quite difficultly.
What is the old saying that, and this is not exactly how it goes, but you should be bold when others are squeamish and squeamish when others are bold, or something like that. And when it drops out, are you essentially buying at a bargain?
Well,
I guess it depends on what you're buying.
Yes. The interesting thing is, before we went on there, you asked the question about investors' attitudes. Everybody's forgotten about the bad markets. They all think it's going to be wonderful, and trees continue to grow to the sky. And so right now, investors aren't being cautious enough, in my experience. And likewise, after the market falls and we're down 38%, and you begin talking to them about it's time to get back in, they'll be a bit conservative. So they're a bit late in their judgments most of the time.
And this is cyclical. We see it time and time. There's not going to be an escape. It's not just going to keep going up.
Well, you saw on the chart earlier, over the past 14 years that we have had 2 cycles that we've completed. We're about halfway through the 3rd cycle. I think we're at the peak, and we're ready to head downward to another trough. 70% of the stocks on the New York Stock Exchange today are trading in bullish territory. 70% is a resistance line. It's a proven number, and when we hit 70%, we can't go very far beyond it. We bounce back from there. So that's got to be the next major move in the market. I just don't know when.
What do we do?
Here's what you do. Number 1, cash is king. My personal clients are 50% in cash today. That tells you that we think that a market correction is on the way. The second thing I think you ought to be doing is talking to your advisor about making certain that your investments are in the top 40% of investments in terms of relative strength to one another. If you're talking with an advisor who doesn't know what relative strength means, get a new advisor.
Get a different one. All right, Barry Watts, thank you so much. If you have a question or a topic for Barry that you'd like for him to talk about, or any kind of questions at all, just email moneymatters@color10.com, and we might just answer it on the next edition. Thank you so much for
Thanks,
coming
Barry.
in.
Thanks for having me.
Always a good lesson. We'll be right